Welcome to vTalkInsight, Allocator's Lens Daily for January 28th, 2026. We come in today with global equities near highs, the dollar on the back foot, and gold at record levels, all against a backdrop of sticky inflation and heavy fiscal stimulus. For cross-asset allocators, that mix raises important questions about how durable this late-cycle expansion really is and which risk hedges are actually working. Starting with equities, the dominant story is still growth resilience powered by fiscal stimulus and the artificial intelligence investment cycle. Strong government spending across major economies and large-scale AI-related capital expenditure are keeping global growth expectations firm, with some internal forecasts now running slightly above market consensus. That support, alongside expectations that the Federal Reserve ultimately has room to cut rates later this year, helps explain why major indices, such as the S&P 500, continue to grind higher with volatility in the mid-teens. Beneath the surface, leadership is evolving. Mega-cap technology and semiconductor names remain central, with AI-linked stocks in markets like Korea driving sizable rallies even in the face of renewed tariff threats. Company news from chip makers and suppliers, including large multi-year investments and new product launches, underlines how committed the sector is to expanding capacity for AI demand. At the same time, earnings growth is broadening. Forward estimates are rising not only for big U.S. names, but also in Europe and Asia, and the share of S&P companies outperforming the index has recently pushed above 60%, suggesting healthier breadth than earlier in the cycle. Valuation, however, is an increasingly important constraint. U.S. equities trade on elevated multiples, and the rally has taken the index back toward peaks, so further upside looks more dependent on earnings delivery than on multiple expansion. Smaller companies illustrate that tension. The Russell Small Cap universe has seen faster earnings upgrades than the large cap benchmark and still trades at a notable price to earnings discount, although that gap has started to narrow. Outside the U.S., international and especially European value stocks remain on significantly lower valuations and higher dividend yields, with some sectors such as pharmaceuticals, consumer staples, and luxury goods pricing in a lot of home market pessimism despite global revenue streams. Flows and policy risk are adding another layer of complexity. Institutional portfolios are still concentrated in mega-cap technology, yet modest reallocations into cyclicals like industrials and energy have produced outsized moves there, highlighting how thin liquidity can amplify rotation. Defensive sectors such as staples have outperformed in recent pullbacks, reflecting ongoing demand for safety even as AI beneficiaries race ahead. Policy headlines are also biting at the margin. Healthcare names exposed to proposed flat Medicare reimbursement have sold off sharply, and parts of the luxury complex are struggling with weaker demand and tariff uncertainty, even as watches and jewelry that are perceived as stores of value are holding up better. A critical question for the equity outlook is how long corporate earnings can stay strong while the average consumer comes under pressure. Data point to a K-shaped backdrop in which profits and AI-driven productivity improve even as wage growth barely outpaces inflation and consumer confidence weakens. Autos are preparing for a more price-sensitive buyer, and confidence surveys show more households viewing jobs as hard to get. Earnings so far are roughly in line with expectations rather than spectacularly beating them, which tends to trigger more muted price reactions at these valuation levels. For allocators, that combination argues for paying close attention to how earnings revisions, sector-level policy shocks, and any rollover in AI CAPEX translate into the next leg of equity leadership. Turning to rates, the picture is one of competing forces. On one side, fiscal expansion and AI-enabled investment are keeping growth expectations solid, with some projections for U.S. gross domestic product around 2.5% or slightly higher. On the other, inflation has become more stubborn, particularly in goods, where tariff-related cost pressures and supply constraints have reversed earlier disinflation. That mix means many investors now expect inflation to run above 2.5% into year-end, which argues for the Federal Reserve to keep policy on hold for the time being. Policy expectations are therefore finely balanced. Several narratives coexist. One sees the Fed pausing additional cuts because of lingering inflation risks and the lagged impact of earlier easing. Another anticipates that a new, more dovish Fed chair and softer labor data will open the door to 2 or more cuts later this year, with politics as much as economics driving the tone. Markets are also alert to the possibility that upcoming revisions to jobs data reveal that earlier employment strength was overstated, which would strengthen the argument for renewed easing. Beyond the Fed, structural fiscal concerns are becoming more visible in bond markets. Rising government debt and sustained deficits raise the risk that investors demand higher-term premia, as seen recently in the sell-off of long-dated Japanese government bonds following renewed fiscal fears. That episode reinforces a theme we have highlighted in recent days. Long maturities still play a role, but they look less like simple, one-way hedges and more like tactical tools. With large amounts of cash still parked in money market funds even after earlier rate cuts, allocators are watching whether any decisive shift in inflation or labor data is enough to pull duration back into favor. In credit, the surface remains calm, but some undercurrents are building. Corporate earnings stories from names like General Motors, Boeing, and several industrial and technology suppliers point to robust profitability, cost control, and in some cases, upgraded guidance. Auto finance operations and logistics firms are still contributing meaningfully to group profits, even as they monitor rising delinquencies and trim less profitable business lines. That resilience contrasts with signs of consumer stress, from weakening confidence to more price-sensitive demand for big-ticket goods. Tariff policy is another important credit variable. Evidence suggests that recent U.S. import tariffs are being absorbed largely by domestic importers rather than foreign exporters, squeezing U.S. company margins rather than overseas suppliers. For investment-grade borrowers, that might be manageable, but it increases dispersion across sectors and issuers, especially where pricing power is limited. At the same time, a weaker dollar and improving fundamentals are helping emerging market borrowers, with some issuers taking advantage of demand for euro-denominated paper as part of a broader shift away from U.S. dollar dependence. Within the broader credit ecosystem, industry developments also matter. The acquisition of an established credit manager at what some see as a discounted valuation highlights an ongoing debate about how to price alternative asset platforms at this stage of the cycle. Meanwhile, emerging market assets are drawing interest thanks to steadier fiscal positions, credible monetary policy, and the currency tailwind from a softer dollar. Overall spreads remain tight, but the combination of consumer headwinds, tariff-induced margin pressure, and political risk around regulation suggests allocators may want to lean more on issuer selection than on broad-based exposure. Foreign exchange markets are doing much of the macro-heavy lifting. The U.S. dollar has weakened to its lowest levels in several years on a broad basis, even though U.S. growth forecasts remain relatively strong. Markets appear focused instead on expectations for further Fed easing and on political signals that the current administration is comfortable with a softer currency. The cost of hedging against additional dollar weakness has climbed to its highest level since the early 2000s, underlining how pervasive that bearish sentiment has become. Beneficiaries of this trend include both developed and emerging market currencies. The Swiss franc, euro, and pound have all gained ground, and emerging market currencies are seeing support from improving fundamentals and reserve diversification away from the dollar. At the same time, policymakers face constraints. In Japan, authorities can move the yen in the short term through intervention, but without credible policy changes to lift growth or adjust yield settings, history suggests those effects fade quickly. Japan also has limited room to push bond yields much higher without hurting its own economy, which complicates any attempt to engineer a durable currency strengthening. More broadly, de-dollarization is a slow but visible theme. Central banks in emerging markets continue to accumulate gold, and some sovereign borrowers are increasing euro-denominated issuance to diversify their funding base. Political tensions and new trade agreements, such as the one between India and Europe, further encourage a gradual shift in trade invoicing and reserve composition. At the same time, investors are adopting new tools, including AI-driven sentiment analysis from social platforms, to monitor early signals of currency moves around political events. For allocators, the FX complex is increasingly central to expressing macro views on policy credibility, trade realignment, and inflation hedging. Commodities round out the picture with a striking mix of risk-on and risk-off signals. Gold has surged to consecutive record highs, supported by central bank buying, concerns about currency debasement, and persistent geopolitical tension. Notably, gold is rallying alongside equities, suggesting investors are seeking insurance against policy and fiat currency risks, even as risk assets perform. Silver has joined the move, but here the tone is more speculative. The metal now trades at historically rich levels relative to oil and copper. Exchange-traded fund holders are starting to sell into strength, and intraday price swings have reached double digits, all of which point to elevated volatility and the potential for sharp reversals. Energy markets are dealing with their own shocks. A severe Arctic blast in the U.S., following an already colder than normal winter, has disrupted natural gas supply and spiked heating demand, pushing benchmark prices to nearly double within a short period. Europe, which now sources roughly a quarter of its gas from U.S. liquefied natural gas, is feeling the knock-on effects through more volatile local prices and greater sensitivity to U.S. weather events. The global LNG system is flexible enough to reroute cargoes, which reduces the ability to use gas as a geopolitical weapon, but also means regional weather or policy surprises can ripple quickly across markets. Industrial metals tell a more structural growth story. Copper and other base metals are benefiting from both cyclical demand and strategic stockpiling as major economies race to secure critical minerals for electrification, defense, and AI-related infrastructure. Europe's drive for energy autonomy is likely to accelerate renewable investment, even though it still relies heavily on Chinese technology, adding a further layer of supply chain risk. Electric vehicles are a good example of this mixed picture, with European subsidies and aggressive Chinese competition pushing adoption higher, while changes to incentives in the U.S. may slow the pace there. For commodities as an asset class, the key tension is between robust secular demand linked to the energy transition and the risk that any global growth setback would still deliver a classic cyclical hit to prices. Stepping back, today's cross-asset picture is one of late cycle strength with growing tension points. Equities continue to be supported by AI investment, fiscal expansion, and broadening earnings, yet elevated U.S. valuations, consumer strain, and sector-specific policy shocks argue for more selective risk-taking. Rates markets are caught between sticky, tariff-influenced inflation and the prospect of a more dovish Federal Reserve later in the year, all while persistent deficits and episodes like Japan's bond sell-off keep term premia in focus. Credit still looks benign at the index level, but consumer headwinds, tariff pressure margins, and debate over alternative asset valuations point to greater dispersion beneath the surface. In currencies, a weaker dollar, rising hedging costs, and gradual de-dollarization are reshaping return and risk for both developed and emerging markets. Commodities complete the mosaic with record gold, frothy silver, weather-driven gas volatility, and structurally supported industrial metals tied to the energy transition. For allocators, the watch list now spans earnings revisions, labor data, policy signals on tariffs and the Fed, and any signs that today's currency and commodity hedges start to diverge from equity risk. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.